we've got a good group now. I'm going to go ahead and kick it off. I'm Kate Westfall. I'm COO of Global Ag Investing. We've been really enjoying this webinar series, and thank you all for continuing to join us week after week as we are working from home mostly. So we're thrilled today to have Jeff Mcallister and Marcus Mitchell from Bonnefield Financial join us. This is going to be the first time we've heard a purely Canadian perspective, and I hope that you all enjoy what you're about to hear. Throw your questions into the Q&A chat, and after the presentation and discussion between Jeff and Marcus, we will get to the Q&A at the end. So let's keep it interactive, and I hope that we have a great discussion. So with that, I will introduce Jeff Mcallister to start us off as soon as I give him control of the screen. All right, Jeff, you should be able to take it away.
Awesome. Well, thanks, Kate. And I guess thanks to the Global Ag team for having Marcus and I on today. I know certainly from our perspective, have been listening to many of these webinars as they've continued to roll out since mid-April. And, I found them super beneficial for those of us in the space to hear more broadly what's kind of going on from a global perspective. Marcus and I kind of had a chuckle this morning. We're both actually in our offices here in Toronto, appropriately socially distant, but it was the first time we'd seen each other, not on a Zoom call, in almost 3 months. So it's amazing how time flies, and we're all kind of adapting to the new normal in terms of social interactions, the economic slowdown more broadly, and working remotely. But I think, in light of that situation, we were hoping to chat just a little bit about how we've seen the COVID-19 situation play out on the ground, and what we think investors should be focusing on as we kind of continue to be in this economic climate. For those who did just join, I think the plan is, we're probably speaking for about 30 minutes or so. And then Kate's gracious enough to facilitate a bit of a Q&A to the extent anybody wants to continue to hear us speak. But I'll provide a little bit of background just on Bonnefield and what our investment thesis is before diving into the COVID situation and what we're expecting to come of the situation as it continues to roll out. So in terms of Bonnefield, for those who haven't heard of us prior to this conversation, we are the largest farmland investment manager in Canada. We have about 900 million in assets under management spread across 4 funds, and that represents about 127,000 acres across the country. We were established back in 2009, and we're really one of the first institutional investors in the asset class in the country. And so we've certainly seen the growth of the asset class, really from its nascent days back prior to 2010 to really what it's become now. On the farm side, we're really seen as one of the leading alternative financing solutions for farmers across the country. We're working with over 113 different farm families from coast to coast, helping them deal with a myriad of potential business issues they might be having. And our primary mechanism for providing financing to farmers is through sale-leaseback transactions. And the reason we chose this methodology is it continues to provide farmers with long-term access to their land, as well as allowing them to maintain the flexibility and operational latitude to operate their business as they kind of see fit. We've seen the popularity of this tool increase over the last decade or so, and really farmers are using it for a variety of different reasons, ranging from cleaning up their balance sheet to facilitating generational transfer, and increasingly as a platform to help them grow and scale up their operation. This model certainly is unique in the Canadian context, and we've been pleased to see the growth and popularity in the farm community over the last decade or so. And for our part, that really makes us a land-focused investor. And our priority is giving investors access to high quality agricultural land with top operators, and ensuring that land is well taken care of into perpetuity. And so one of the ways we're able to mitigate some of the risks that come with this is really by primarily focusing on the top growing regions across the country. And we're fortunate in Canada, there's a lot of high quality growing areas that are really quite varied. And also to our benefit, they're probably less well known than some other parts of the world. And this broad level of diversification and high quality land has really allowed us to invest across the country and apply our thesis from coast to coast, starting the lower mainland of British Columbia up to the northern reaches of the Peace River District in northern Alberta and BC, all the way across the country to the Maritimes with our easternmost properties in the Annapolis Valley of Nova Scotia. And so one of the core tenets of our investment philosophy is ensuring portfolio diversification for our investors. And when we say portfolio diversification, we mean not just by geography, but also by crop type, as well as specific operator. And so I think because of the sheer size and vastness of Canada, we're able to provide this diversification. And I think turning the conversation more to the COVID-19 discussion, when we talk about what we're seeing in the farm community and what we're hearing from farmers, it's really from this broad diversification across the country from which we've decided to kind of provide our insights and feedback. So, like most investment and portfolio managers, we've been monitoring the COVID-19 situation since it really began in North America back in early March. And, we started, simply by, getting feedback from our farm partners before expanding that to, others in the agricultural community and other stakeholders, both in Canada and abroad. Our initial priority was really more from a property management perspective. We wanted to ensure that, our farm partners, if they had any potential issues, they knew we were there to work with them and manage through any, potential shocks to their business. And I think fortunately, many have managed quite well throughout this crisis. But I think what we also wanted to do is provide feedback on an ongoing basis to our investors and other stakeholders. And so, we've kind of gotten the pattern of every sort of couple of weeks providing a regular update. And really these updates, which are the basis for a lot of the discussion today, are basically just a consolidation of the feedback we're hearing from the farm community and putting that into writing. And I think before diving in fully, I think it's also safe to say that the situation is still evolving. It's still very fluid, and some things are changing almost on a weekly basis. But I think at this point, almost 3 months in, there are some shorter, medium, and longer term trends that we can point to, and expectations we have for how the sector will continue to evolve going forward. So I think when it comes to the headline for the agricultural community is that we've actually fared pretty well, especially on a relative basis compared with many other industries that have been much harder and more impacted by COVID-19. That being said, the immediate impacts have certainly been beneficial to some, detrimental to others, and have created certain winners and losers. The first significant government-imposed restriction was the effective shutdown of much of the broader economy, with the focus on curbing the spread of the virus. This obviously had a significant and hard impact on the service-oriented businesses within the economy. And so from the agriculture perspective, this really was the food service industry. And this includes establishments like, dine-in restaurants, fast food chains, but also catering businesses, as well as, hospital and school cafeterias. So the effective shuttering of, that basically half of the food distribution system forced consumer behavior and consumer buying patterns over to the food retail sector, which has obviously seen a significant uptick as a result. The global supply chain in agriculture is also, quite large and quite complex, and this has obviously been impacted as well. You've had the shutting of international borders, restrictions placed on, migrant labor and travel across borders, as well as, businesses having to adapt to, social distancing requirements on an ongoing basis. And so just given the vast complexity and interconnectedness of the global supply chain with respect to agriculture, which ranges from, input providers to grain elevators and, international shipping, any small hiccup in this chain has a ripple out effect. And so certainly they've been impacted as well. And then finally, I think, there's just been a general decline in the demand for many commodities, obviously agricultural soft commodities, but also things like oil as general economic activity has slowed down. So I think our goal here is really to unpack each of these, what kind of winners and losers it's created in the immediate term and how we expect these to kind of play out going forward. So as we alluded to, and I think has been well documented and covered by the press, effectively there was a complete shutdown of the food service sector, and this has been a huge boon to the food retail part of the industry. And it was interesting, if you dive down even more, what specific crop types and foodstuffs have been most affected by the shutdown. So things like fresh seafood and higher end cuts of meat, which traditionally have almost exclusively been channeled through food service, have seen a huge hit to their business. But on the flip side, there's been significant increases in demand for many other types of foodstuff, especially with the uptick in the amount of home food preparation that's occurred. So things like fresh fruits and fresh vegetables have performed extremely well. I think what's also been interesting as we've monitored the situation over the last couple of months was to shake out, what were your short-term temporal shifts versus the longer-term anticipated demand. And so we saw early on in the crisis, demand for shelf-stable, non-perishable items like rice, pasta, canned fruits and vegetables see a significant spike. And in hindsight, some of this was probably predictable. This is similar behavior to what you'd see in cases of natural disasters like hurricanes or tornadoes, where folks flood to the supermarkets or flood to the grocery stores and stock up for fear of not knowing when they're going to be able to purchase again or not wanting to go back out into that environment. But fortunately, I think especially for food retailers, that sort of demand peaked, as you can see on the second chart. And I think we're into a bit more of a steady, long-run expectation as long as we're in COVID in terms of what fruits and vegetables or what specific types of items are in demand at the retail level. So I think, to summarize this, huge spike for food retail, unfortunately at the expense of the food service sector. And so for investors who were focused on crop types or processing operations that service primarily food retail, they likely did extremely well over the last couple of months. Whereas those that service the food service sector have likely struggled to adapt. That being said, there's still a lot of effort on the food service sector trying to channel their distribution into food retail, as there still is high level of food demand. But obviously it's easier said than done, just with the differences in packaging and presentation that's required from different customers. Looking forward, we anticipate food retail to continue to outperform, certainly in the short term, but also out into the medium term as well. Again, with the passage of time over the last couple of months, we've been able to tease out some real data that's coming back. And you can see that across the broader consumption pattern of the economy, there's been a decrease in demand for many items and causing a bit of deflationary pressure. But the one point that really sticks out is, an inflationary environment for fresh foodstuffs. And this makes a ton of sense. Similar to what we showed on the last page. Really the demand as the shift to food retail has put increased pressure and buying patterns from this food group. What's also interesting, though, is thinking about how you anticipate that demand to continue going forward. And what's interesting, if you evaluate prior recessions, this is looking at the chart in 2008, if you break out the percentage of buying that's happening, food away from home versus food at home spend, you see food away from home during recessionary environments tends to decline. And this makes a ton of sense, as people are generally tightening their wallet and hesitant to outlay those kind of expenditures. But what's more interesting is that the resumption of those buying patterns generally has a longer tail than the actual recession itself. And again, I think this ties to the fact that consumer behavior doesn't react overnight as soon as the government says the recession is complete. And I think if you look at what happened in 2008, it's likely to be more exaggerated during the COVID-19 crisis, as I suspect that we're unsure when businesses are actually going to be able to reopen in a meaningful way. And I think the psychology of consumers is likely changing with the social distancing requirements. And the final piece I'll sort of just touch on before maybe shifting over to Marcus, again, tying to the food service, food retail side of things, has just been how the soft commodity market has performed. And I think when you look at a lot of the soft commodities that are presented here, a large majority of the buying happens from the livestock sector. Sorry, thanks, Kate. A large part happens from the livestock sector. And, you know, the livestock sector has also, you know, taken a bit of a hit just in light of the slowdown in demand from food service, as well as, you know, other issues relating to processing capacity, which Marcus will touch on. But, you know, it's difficult to understand and see how this commodity environment is really going to change as COVID continues to play out. One beneficial piece we've seen in Canada is that, you know, at the same time that commodities have been hit, the Canadian dollar has also taken a significant hit as well. And so, you know, Canadian farmers have been moderated somewhat by those impacts and haven't felt quite the same blow as our American counterparts. Maybe the final part I'll just touch on before handing over is just the corn situation, which I know has been covered by some other presenters as well. But, you know, corn amongst the soft commodities has probably been the hardest hit. Obviously, the livestock sector is one part of the story, but the other big piece is the decrease in ethanol production more broadly. And so, you know, this has fallen in line with what we've seen in the oil and gas sector and the decreases in prices there. But again, in terms of the short and medium term, as long as travel restrictions continue to be in place, people are hesitant to get out from their homes. It's tough to see an environment where, you know, this paradigm is likely to significantly change. So again, sort of in summary, I think food retail has definitely been the beneficiary, and some of those other crop types and foodstuffs that have focused primarily on the food service sector are likely to continue to be depressed in light of COVID. So maybe with that, I'll hand over to Marcus to kind of continue the discussion.
That's great. Thanks, Jeff. Good afternoon, everybody. You know, I think as Jeff has been unpacking for us, I think it's really important to keep in mind that first and foremost, you know, we're really evaluating a rapidly changing landscape. You know, we're not yet a full quarter into the post-lockdown environment and the realities that's presenting. But of course, as farmland investors, we look at investing as a forward-looking activity. And so while we can interpret what we've been seeing, we think probably more important, we need to shift our focus to see how is this setting up for the short-term and medium-term periods, and what is the outlook looking like for investors as we move forward. And to do so, I think as Jeff said, it's critical that we look further down the supply chain at, of course, the end consumer and the intermediary processors, which are really the customer for the folks that we work with, the primary producer, to understand the dynamics of what's happening. And so, as Jeff had said, sorry, Kate, I'm having issues with the slides here. Am I able to move them? There they are. Okay, thank you. Okay, so sorry, coming back to the discussion. Obviously, when we think about the situation with corn as a bellwether commodity in the United States and North America generally, the major consumers of the U.S. corn crop are, of course, the ethanol sector and probably just as importantly, the livestock sector. As Jeff had indicated, obviously the collapse in the price of oil, which we all witnessed, and really the reduction in food service, obviously the reduction in eating at restaurants, hotels, and obviously the leisure and travel industry, have had significant impacts on decreasing the absolute demand levels for obviously energy and livestock. And the related agricultural industries, ethanol, have seen that their margins collapse. When we look at the livestock sector, I think what's really been very clear for observers of how COVID-19 has been impacting the agricultural sector, one of the major hotspots for COVID-19 outbreaks, as we've seen over the last couple of months, has really been meat processors and meat packing plants. These are businesses really where people are working long hours in close proximity and in closed environment, really a recipe for COVID-19 transmission. And those physical realities are creating further problems for livestock producers. So not only are they seeing, of course, absolute demand fall from the food retail channel, but the actual ability for the processors to take supply for the demand that there is has been hampered as well by the fact that many of these plants have been experiencing sequential and systematic rolling shutdowns. The net effect obviously being even even more reduced demand on farm, but obviously at the retail side, setting up for potential shortage as we move forward. And so when we look at really the sectors of US and North American agricultural commodities that have been most impacted, as you can see in the chart, of course, ethanol has been probably the leading loser through COVID-19, followed closely by livestock, and then subsequently by some of the major commodities, probably leading corn in terms of the bigger losers because of the impacts of the two major consumption channels that grain moves into. Of course, other major commodities are also involved in these sectors, but probably to a lesser extent as corn. But of course, many of these crops compete for the same land base, and so tend to have a fairly tight relationship over time as far as pricing is concerned. And so from our perspective, what does this look like for an investor that's thinking about what do the next couple of years look like? Well, really, these challenges are causing, and what we're seeing is these supply chains are really adapting and adjusting to this new post-COVID-19, post-lockdown reality where demand has really retraced significantly. And so what we're seeing is significant reductions in inventory for livestock producers, and of course, on the energy side, significant cutbacks in capital expenditure, and for high margin producers, they're simply not going concerns. So the go forward reality for the energy and the livestock sector is really, it's adjusted to this new lower demand environment. And from where we sit as investors in farmland, this is a really important concept to understand as we think about the go forward. We're not the only ones to say this, but really this is exposing the absolute fragility in global, but of course North American food supply chains. And this reduction in absolute supply and capacity to supply is not something that can be reversed quickly. Obviously, these CapEx investments and these businesses that have really ceased to operate and building back livestock herds, this is not something that can be enforced overnight. It's really a multi-quarter and multi-year process to build those inventory stocks back up, to bring back that capacity online. And in a recovery, this has significant implications for the prospects for the price of agricultural commodities. Of course, these are the customers that buy the majority of the major commodity products in North America. So when we think about the medium term and what this COVID-19 situation is setting us up for, we think there's a couple of key points to keep in mind. Of course, I think the Federal Reserve of the United States made major headlines with the announcement of multi-trillion-dollar record level rescue packages, really designed to stabilize markets, balance asset prices, and provide some confidence back to the markets, and really offset what had happened with respect to rapid declines in money velocity and creating really a broadly deflationary environment. That of course, has had some effect and some use, and of course creates an environment where asset prices can stabilize somewhat. But given the fact that many folks are still living in a lockdown environment, that doesn't actually create the real demand needed to see prices kind of improve over time. This has been coupled with record fiscal stimulus, obviously, that we've been seeing, and obviously equally large measures being announced in the United States, and really for most major developed countries announcing fiscal stimulus responses and monetary responses designed to combat the worst effects of COVID-19. Now, of course, they don't replace lost income, and obviously the unemployment numbers that we've seen have been astronomical, but they are designed to really take the worst effects of a rapid deleveraging event, mitigate that, and really to set us up for a strong and rapid recovery, which is really what we're seeing. And our view is this environment is being established against a backdrop of a now adjusting and soon to be adjusted global supply chain with respect to food and energy that is going to, of course, when we see a recovery, have to start keeping up with a new reality for global demand. And really, as we think about the forward-looking projections for agricultural investment, this is critical to understand because of the delays in bringing those inventories and that capacity to supply back online. Our view is in a rapid recovery, this could create some structural imbalances where you have demand outstripping supply for a number of periods into the future as we think about what a recovery could look like. And of course, I think it's really important to visualize and understand the magnitude of the policy responses that we've seen. I think we understand that these are massive numbers, record in absolute terms, multi-trillion-dollar rescue packages coming from the US Fed, but as a proportion of GDP, probably equally or larger responses in the Eurozone and with other countries globally. So the basic view is that the global monetary base for most major currencies has expanded rapidly in response to COVID-19, really designed to offset the deflationary effects of a rapid decline and decrease in money velocity. And, of course, the overall deflationary environment that we've seen has been playing out in the energy sector, of course, in a lot of the industrial sectors, with some of the few bright spots probably being food and medical supplies, the things that people really need at all times, and particularly during a pandemic, seeing significant inflationary behavior change due to these behavior changes that Jeff had talked about. So really, our view is these policy responses, these monetary responses, these fiscal policy responses are creating the environment that's almost like kindling, where in a recovery, a spark of a recovery, and of course we're seeing, if we look to Asia, areas that have really experienced this COVID-19 pandemic and had a response to it a couple of months probably prior to North America, are already seeing life kind of return to some semblance of normalcy with the economy opening back up. And of course, quite a lot of positive news with respect to vaccines and treatments and testing, making tremendous advances that are giving folks more confidence. Our view is these policy measures are designed specifically to create the environment for a rapid and robust recovery. And as an investor and as a market observer, one should be concerned about the implications for inflation in that environment. And we think this is something that's been recognized by the market. And when we look to gold prices, and of course, when we think about gold, it's widely known as a haven asset and an inflation hedge, and of course, a risk-off asset during uncertain times. We've seen the performance of gold really outstrip broad other asset classes during the recovery, as it should, after an initial deleveraging period. And of course, when we think about farmland has similar characteristics and has often been compared to gold in some respects, with respect to one critical property, and that is that it has intrinsic value and it has very limited supply. So assets with intrinsic value and limited supply against a backdrop of a rapidly expanded monetary base really sets the potential stage for future inflation. And that's something as a investor that we're looking at. So what could this look like? I mean, really, if you see demand coming back online, people quickly wanted to travel due to pent-up demand, wanting to go to restaurants, all of a sudden, these supply chains that need to provide the energy, need to provide the livestock that really supports this demand are going to be playing catch up. And due to these structural imbalances where that can't come back on in the near term, we predict there will be a situation going forward where demand will continue to outstrip supply in a recovery. What does that mean for the folks that we work with? Well, basically, much more competition for the products that are coming off the farms of primary producers. And as a farmland investor, of course, looking to provide the capital to make sure that those farms are well capitalized and able to do this, would be seeking to earn a return from taking that risk. I think what folks can anticipate is being invested prior to a recovery would be very important, because as this recovery unfolds and farm incomes improve, coupled with low interest rates and availability of capital, you can expect farmers to be significantly investing their surplus and free cash flow back into farmland. So of course, the situation that's unfolding ahead of us from our perspective could be quite beneficial for farm incomes. And of course, that gets capitalized into farmland values over time. Now, of course, this is something the market has recognized. It's not simply gold that has performed well. If we look at publicly traded comparables or publicly traded alternatives of farmland assets, mostly listed in the United States, we can see that they too have performed very well and are in fact are significantly above where they were pre-lockdown and pre-pandemic. Really, we think this is telling a story of how the markets have responded and recognized the fact that food is a critical necessity, it's a staple, and farmland itself is very much a fixed supply asset. So as we think about that situation, of course, over the medium term, we think that's setting up for a situation which could be quite attractive for investors in the space. But as institutional investors look at global farmland investing, global agricultural investing, there's a lot that hasn't changed. And probably more importantly, as we think about farmland investing as a very long-term investment, the elements that haven't changed are critical to keep in mind. And of course, probably highlighted more than ever in an event like COVID-19. So, of course, one of the major features of farmland investing is, of course, it forms a part of a well-balanced real asset strategy. And of course, institutional investors are now starting to realize that commercial real estate and parts of infrastructure portfolios are of course linked to global economic activity. And the prospects for some of these investments obviously have taken significant hits with respect to the working from home movement, obviously social distancing measures, and the reduction in travel and use of trade infrastructure. So of course, when we look at why do institutional investors want to invest in real assets in the first place? Well, really they're looking for those inflation hedges, those long duration liability matching assets, and really the ability to provide cash flow as a replacement for debt in a low interest rate environment. And of course, this is exactly what farmland can provide, but of course with significantly different exposures than the other major asset classes in the real asset space. You know, of course, as we've just talked about, the inflation environment is of course a critical one to keep in mind. And due to the policy responses from both fiscal and monetary policy, the interest rate environment is of course looking like we'll be in a low interest rate environment for the foreseeable future. So those elements have really come out. As the news cycle has changed, of course, elements like climate change, which were of course a key part of the news cycle back in 2019, have not really received the same kind of attention that they were. Of course, these long-term structural problems have not dissipated. And so as investors are thinking about their strategy with respect to their agricultural portfolios, we think these long-term durable trends are critical to keep in mind. They certainly are secular, and they haven't gone away merely because of a pandemic. Really, the structures and the systems that keep them in place are very much in play. And so when we think about why Canada in a global agricultural investing context, you know, this is one that is critical to keep in mind. And when we think Canada has major advantages with respect to sustainability and its prospects with respect to climate change. When we say sustainability, we really mean the capacity for those systems to continue to provide value over time and in a manner that does not degrade over time. And why do we think Canada is well positioned to do that? Well, the first and foremost, access to water is a critical feature in assessing an agricultural system's ability to be productive over time. And of course, Canada, as we all know, is well endowed with respect to its access to water and uses very little of this fresh water supply in its agricultural activities relative to other areas. So when we think about both the adaptive and the mitigative approach to climate change investing, you know, we think that Canada, of course, due to its northern latitude, is probably positioned to benefit relative to other areas. As climate warms, more northerly latitudes are going to see longer growing seasons and the capacity to produce more crops more profitably. But of course, from an adaptive perspective, the capacity to apply water, remove it, and have the infrastructure to manage that becomes critically important as well. And on these features, we think Canada really is well positioned, perhaps relative to some other geographies around the world, to benefit strategically over time, given these secular trends. And of course, much of this has been highlighted through the events of COVID-19. So in summary, you know, I think obviously we tried to identify what the short-term impacts have been, the medium-term outlook, and of course, the real fundamentals driving the long-term performance of agriculture, and particularly agriculture in Canada. And so we think the important things to keep in mind is the real winners here have been farmers exposed to the food retail sector. And really, this is primarily fruits and vegetable farmers and folks that produce products that go right to grocery store shelves. Really, the folks that have suffered and might be suffering in the short term here are folks that are more food services derived. And this would be folks that are really providing products that go into the livestock sector, go into the restaurant, travel sector as well. But over the medium term, our view is this new adjustment with supply chains really adjusting their capacity to supply downward to reflect a post-COVID-19 reality really is going to struggle to keep up with what will happen to demand in a recovery. And really that's an important thing to keep in mind as we look forward. The conditions created by monetary policy and fiscal policy are setting up the situation where we expect a very rapid recovery when the conditions allow for it. And of course, given the structural limitations for supply coming back online, we think that creates a structure and a system where systemic inflation might be the reality for the foreseeable future into recovery. And of course, one cannot forget that the most critical piece of considering agriculture investing is the long-term fundamentals, and particularly for institutions that have multi-decade holding period and horizons as they assess these investments. It's critical to think about those major theses that have not dissipated. And really this is climate change and sustainability and what regions stand to benefit relative to others, given those trends. So, I think really in summary that encapsulates our messaging today, and this might be a good time to open it up for a Q&A.
Perfect. Thank you guys so much. We've had a lot of fast and furious questions coming in. So we will get right to it. Thanks for the great presentation. There was a lot of good data in there. I think that we'll just kick it off with, considering where we are with COVID and everyone sort of keeping away from each other, is Bonnefield currently doing farmland acquisition? Yeah. How does COVID affect your ability to do due diligence and source deals and things like that?
Yeah, that's a great question. I can take that one if you like, Jeff. But really, our view is we certainly have been investing, through this period, and our approach has really been, as we've said, we really look at this as a long-term investment. Those fundamentals have not changed, and really, when we think about the situation moving over to the medium term, the whole strategy there is you want to be supplying capital before a recovery occurs. I think once the recovery is occurring or has occurred, you've probably missed significant parts of the potential move that might happen in asset prices, and obviously the returns expected from supplying that capital. So we have certainly been investing, and really our ability to do that is entirely based on the fact that we've built this infrastructure and this network across Canada that enables us to do this. And this is from investing really coast to coast over the last 10 years. So when it comes down to the networks of farmers that we know, service providers that we work with in all these geographies, really the ability to identify, assess, underwrite, and execute on a transaction. We've been very pleasantly surprised that we can do that quite well from our desks and even from our homes. And by relying on these networks, we can get just as much information as we might have otherwise got. I think maybe the elements that are more difficult is obviously meeting new farmers, developing new business, but most of the business that we've been doing has been concentrated on supporting our existing farm partners and making sure that they are in a really robust position, not just to weather out the storm, but really thrive through it and be in a position to do very well when a recovery occurs. And of course, for those folks that are in the food retail space are doing fantastic. And so we've continued to invest there. Great, thank you. I'm going to sort of combine a couple of these because I think this is pretty interesting, Jeff. Maybe you can take this. How might COVID-19 impact exports of agricultural products over the next 12 to 24 months out of Canada? And then a follow-on to that, with the U.S.-China trade wars, are you also going to see some medium to long-term effects from that?
Yeah, sure. Happy to kick that one off. I guess sort of, two separate questions, just the export opportunities more generally, and just, the relationship with China and the U.S.'s relationship with China. So, I mean, I think in terms of the China situation, maybe first, Canada, we've had our own kind of documented, specific issues with China going back to the Huawei and canola situation last year. But at the end of the day, purchases are still happening. A lot of it seems to be political rhetoric. There has been some slump in some of those prices, but at the end of the day, there's a limited pool of commodities that China or those other major markets can purchase from, and so those are still moving. I think early on in COVID, there certainly was a significant slowdown in global trade, just as countries were adjusting and international border situation was kind of playing its way out. But similarly, Canada, to our benefit, is a net exporter of many agricultural commodities, global provider to much of the world. And so, there's still demand for a lot of those products. Some have fared better than others in light of, the shift between food service and retail. But I think it still kind of remains robust, and people kind of have to eat at the end of the day, and there's only a limited pool. So, I think from where we sit, we'll continue to monitor it and see, how it continues to play out. But products are still certainly moving. And I think at the end of the day, it comes down to a global supply and demand situation. So, what's the size of harvest, in Canada and other parts of the globe going to be this year, which I think will have a significant impact, both on pricing and global trade more generally.
All right, great. I have an investor asking, he's based in Utah, asking what are the best and highest margin opportunities that you see in Canada?
Yeah, I can take that one if you like. I mean, really, I think going forward, our thesis, when we think about the higher margin opportunities going forward, we really just step back and think about what are the trends that we're seeing unfold over the long term. And, I think some of the trends that are probably most front and center for us, definitely in the domestic context, is this shift towards probably a greater focus on a bigger proportion of plant-based eating, and the obviously the commodities and crops that kind of lead into that. So some of the more recent ones that we've seen is much more hemp production happening both south of the border and in Canada, but of course production of plant proteins we've seen as a major secular trend, and not just on the lentil side and the pulse side, but this is something that we're seeing play out, and it has been playing out over the last couple of quarters, with India being a major consumer and a major importer of a lot of Canadian pulse crops. But I think more recently, with the advent of a lot of alternative meats, we see the pea protein market and other plant proteins being perhaps some of the more interesting sectors to be focusing on. In addition to the fact that we think our fruit and vegetable sector, given the trends related to climate change and these trends with respect to shifting consumer demand, as more millennials are really taking over the more dominant purchasing part of the North American economy, and we think those trends that are driving a shift towards more plant-based consumption probably are going to be some of the more higher margin opportunities in the medium term. Great.
We've got James coming to us from a public pension fund in California, and he's asking about restrictions. His understanding was that there are restrictions on foreign ownership of farmland in Canada. Are U.S. pension plans allowed to invest in Canadian farmland, and what restrictions might apply?
Sure, happy to provide some color there. So, similar to how the U.S. operates, restrictions on farmland ownership in Canada is governed on a province-by-province basis. So there are certain provinces that are more restrictive than others when it comes to who can invest, whether that be foreign investors or even institutional investors that might be Canadian. And so across our different funds, we make sure that we adhere with provincial guidelines. We're in continuous discussions with the provinces to the extent there's any changes to those types of requirements. But there are a number of provinces that are open for American or foreign investment as it currently stands. And so once again, we kind of build our pipelines understanding who is eligible to invest in those certain geographies, and yeah, so once again, not just a Canadian opportunity.
Okay, great. And just to follow on to that, can you just explain a little bit about your fund structures? So that everybody can sort of understand how they might get some money to you, Jeff.
If we're so lucky after today, but yeah, no, it's we operate 4 vehicles right now. We have certain investment vehicles that are catered towards private investors as well as institutional investors, and within there we have both closed-end and open-ended funds. So we do have some open-ended vehicles that are eligible for foreign investors. And national investors that we continue to raise on an ongoing basis with much of the thesis that we kind of described today.
Mm-hmm. Okay, great. I'm going to change our tack a little bit, and can we get you to comment on what the risk might be to land prices if interest rates start to rise in response to the inflation?
Yeah, so I mean, I think obviously as we're thinking through that, I think obviously our views on interest rates are going to be couched on the ability to actually pay those rates down. And as inflation does occur, of course, the expectation is that's happening, that's also affecting food price inflation and soft commodity prices in addition to agricultural prices. So as long as that's well managed and done in concert with obviously strengthening prices, we think that should be okay, as long as it's done, and really when these discussions emerge, they are really a question of magnitude. And so it really depends. If interest rates are rising or changing within a range that we've really seen over the last 10 years, we don't really see much of a problem, particularly if that's happening as a response to increasing prices, and particularly food prices. But of course, if food prices remain flat or don't go anywhere while interest rates rise, then of course, yes, you're going to see margin pressure and issues in terms of the ability to cash flow those payments and those obligations. So really, I think as people think about their strategy and their thesis, a real question to ask themselves is that likely, and is that structurally plausible given the environment that we're seeing? And were that to occur, what are the conditions that might cause that to occur? And I think an analysis of those factors are really what's going to give someone comfort or not about whether or not that risk is material in the context of farmland investing.
Can you talk a little bit about how your farmer partnerships work?
Yeah, sure. And I think really the way we think about investing is really as a long-term model where we are looking to partner with farmers over the very long term. And of course, this is really a situation that we set up as through our leases, where our leases are designed to be long-term in nature. So really, we set up leases to be revolving, where basically we have a term that basically just extends over time, and is really in effect a perpetual lease. And so, as long as the farmer is willing to farm and able to farm and willing to pay, we want to be working with them over the long term, because we think that creates the incentives to create value and build capacity in the underlying asset. And really that means agronomic capacity. And we think that encourages sustainable practices over the long term. We think when farmers think that they're going to be potentially on and off land over the short term, that disincentivizes folks to really behave well and make sure that they're taking care of the land as if it's their own. So our strategy has always been about the very long term, and we set up our relationships with our farmers that reflect just that.
Mm-hmm. And do you see, just going back to the COVID issue, do you see that is going to contribute to further consolidation of farmland? I guess both in Canada and here in the US.
Yeah, I think consolidation of farm businesses has been a multi-decade trend, without question. We think the effects of COVID and obviously the weakening of commodity prices for North American growers, yeah, for sure. I think that's going to accelerate this effect of consolidation, because folks that have weaker balance sheets are probably not as optimized and have really been disinvesting in their business over the last couple of years, will find it very difficult to survive through challenges in the short term. Our view is, as investors, and of course folks that are looking to build their farm businesses and really be farming over the next couple of decades, this presents a great opportunity, of course, to expand their operations, optimize their operations, strengthen their balance sheets. And that's exactly what we're here to do, to provide that capital to make sure that the best growers that we can find are able to not just survive but thrive through a crisis like COVID-19.
Switching back to sort of the climate and sustainability issue a little bit, you mentioned earlier in the presentation your rating with UNPRI. How is Bonnefield sort of embedding ESG into your strategy? And can you talk a little bit about reporting and performance and how you sort of track that?
I was on mute, but yeah, maybe I can tee this one off. And Marcus, if you want to speak to the specific underwriting,
sure.
Maybe I'll pass it over at that point. But yeah, no, I think when we founded our first funds, back in 2020, I guess earlier in 2009, the ESG component was kind of in its kind of initial wave. We've been an early signatory to the UNPRI set of credentials, so it's something that we've always focused on. We think the nature of the asset class lends itself well to a lot of those broader ESG themes. But certainly, as it's continued to evolve, at the highest level, the value of these assets and the underwriting or the underlying productivity is going to be tied to how well it's managed and the productive capacity. So the right types of grower tools that are actually being used. So this is something that we've always monitored quite closely. These standards of care, as we call them, are tied into our leases on an ongoing basis. And we've continued to look for ways to evolve through our underwriting processes and through some of the other business decisions we make. So this past year, we've been doing a lot of longer term risk modeling with respect to different climate impacts and how they could affect our business. And this has certainly flowed down to the individual investment level in terms of how we invest. So yeah, it's something that's certainly top of mind for us. I think it's a priority for investors as well, as it should be. And we think a growing level of transparency and understanding amongst investors as well as asset managers is important to make sure this trend continues to evolve and grow. Not sure if you had anything else you maybe wanted to add there, Marcus.
Yeah, no, it's a great point, Jeff. I think it's really important to consider that when we think about ESG as a component of our investing. That's really embedded in the strategies that we select, how we do our investing, and of course, how we monitor the assets as good custodians over time. And so when we think about what is our strategy, we're really looking to invest in the most productive and the highest quality areas of Canada that we can. These areas, in our view, are going to carry the lion's share of increasing capacity for production over time. And we're not really looking to be investing in more fringe areas. We don't want to create incentives for deforestation and things like that. We're not looking to invest in Brazil, where obviously by doing so, you might be creating disincentives or incentives for folks to convert land from other uses. And so obviously purely by selecting investments in core regions and looking to optimize the best assets to do what they can do. And of course, by bringing the best available partners to match that physical capital with the best human capital. We think the strategy in and of itself is based on sustainability. And of course, the way we manage and care for the assets over time through our partnerships reflects that. And of course, the other component in our long-term leases is the requirement to maintain what we call our standards of care. And so really these are a set of best practices that we want to make sure that the farm partner that we work with is adhering to. And really these are things that great farmers do anyway. These are things that just make good sense because these are obviously things that maintain the agronomic integrity of the farm, things like sequestering carbon, things like making sure that soil erosion is not happening or that there's excess use of inputs that obviously can leach into the environment. So really by working with advanced progressive farmers that are looking to be really great stewards of the land, great business people, and make great decisions, our incentives are aligned. Really, nobody is looking to, wastefully, put inputs that aren't required or, erode the soil that they hope will be providing them with their livelihood over time. It's just really doesn't make any sense. And so really, I think the whole strategy that we've set up and the way we audit and monitor it over time is really what sets up the framework for a sustainable investment program.
Okay, great. I like this question that an anonymous attendee sent in. It's sort of a crystal ball question. So I don't know which one of you is going to brave this one, but I think it's interesting, on the climate change issue, in terms of what you've seen in productivity impacts on farm, and assuming that we're in the year 2035 or any future year you like, what new types of crops do you think will be growing in Canada compared to today? I think it's a very interesting question.
Well, I think you can just look, several degrees of latitude further south to get a very good clue of what that might look like, right? And so, what we see is, and what we have seen is really a shifting north of the crop varieties that are available. I mean, here's the thing: you can plant anything you want in these areas, but the risk to do so doesn't make sense right now because in some parts of the world and some parts of Canada, the growing season is too short. So the risk you take to do so doesn't pay. That risk paradigm has been changing, and of course, these are not things that really get recognized in an instant from a data point. These are progressive things that happen over time, and this has obviously been compounded by the effect of ag tech, crop science that is creating varieties that can better withstand some of that variance. But we've already seen it really in the 10 years that we've been doing this. Obviously the ability to produce corn and soybeans at more northerly latitudes has been happening. If we look to certain sectors like the Okanagan, for instance, where fruit planting has been moving further north, these are trends that we've seen really in a 10-year time frame, which is relatively short over the context of multi-decade and generational investing. But these are trends that we don't really see dissipating. So if you want a really good clue of what could be happening, look a couple degrees of latitude to the south, and then it's not just what can be grown, but how profitably and at what risk level can those things be grown. And really our view is the risk to do so is dissipating with longer growing seasons. And of course, the ability to do so sustainably over the long term is improving as we've seen the effects of climate change kind of affect the growing regions we're investing in.
And speaking,
oh,
sorry, Jeff, go ahead.
Yeah, not much to add, but I mean, I think the only point I might include is, really, I think farmers are the ones more than anybody who are really pushing the envelope and seeing what can be grown. We've certainly seen migrations of some of our farmers to more northerly latitudes as some of these areas continue to open up. And so, in chatting with them and getting their feedback, it's amazing to see, what their sort of longer term expectations are. But I think to what kind of Marcus alluded to, we've already seen a huge increase in the ability to grow certain types of grains, which 10 years ago just weren't possible in Canada. The fruit and vegetable sector is certainly continuing to grow on a year-over-year basis, in line with dietary trends and those sorts of things we've seen as well. So 2035 is a long time away. So we'll see what happens by that point.
It'll be here before we know it. I'm ready to get out of 2020. I'll tell you that. And Benjamin just sent in a question that's maybe a nice follow on in terms of how you listen to your farmers. He's wanting to know how you audit them for their conservation practices and what incentives, if any, you offer to them for success.
Yeah, no, it's a great question, but really, we do audit it. It's an integral part of our overall management practice, and it's a critical part of the lease. So every year, probably this year, hopefully, but it might be later than we'd otherwise anticipate. But we have a Bonnefield representative visit every single farm to inspect it, to obviously take note of the agronomic structure, the productivity, what's been happening, and whether or not efforts have been made to improve any stewardship or custodial issues that we've noticed. That is obviously complemented also by visits from third-party agronomists that do their own inspection, and of course, significant reporting requirements from the farmers that we work with. So this mosaic of data that we get for every asset that we manage over time gives us a really clear picture of how are the stewardship practices that are actually being implemented on the ground, improving the agronomic capacity of that asset, and of course, reducing the potential for degradative effects like land compaction, erosion, and obviously the effects of the nutrient profile that when not managed well, can become very problematic over a number of years. So it's fully integral to our asset management and property management strategy. And we have a great team of property managers that are very connected and speak with our farmers on a very regular basis to understand what's happening. We make investments at the margin, obviously, regarding capital expenditure to help improve the operations on those farms over time, not just from a profitability perspective, from a sustainability one as well. And so it's really core to what we do, and we have this constant feedback loop with the farmers that we work with, both formal and informal, that really lead to this progression and improvement of the core asset over time, which has been really positive to see over the 10 years that we've been doing this.
How do you view sort of ag tech innovation? Do you have a perspective on that? Do you encourage your farmers to utilize certain tech strategies? Are you using digital farm management tools? How does ag tech play a role in how you sort of track and trace your sustainability initiatives?
Yeah, Jeff, go ahead.
Sure. Yeah, sure. So, sort of two separate. I guess there's how, we at Bonnefield implement and use ag tech, and then separately how the farmers we're working with, prioritize those opportunities. And so certainly from us, from our perspective with Bonnefield, we utilize, a ton of different management, software, visual, spatial visualization tools, those types of things to monitor, remotely what's kind of happening. So these are things we've adapted, early on in the infrastructure of Bonnefield, and that we continue to utilize. And, it's amazing the amount of innovation that's really happening in the space. It's tough to keep up in a lot of ways. With respect to our farmers, obviously, we, tread the line. We're not going to tell them how to farm. Quite frankly, they're the experts, not us. And so, we are working, as Marcus has mentioned, with a number of leading growers across the country who are much more up to speed with specific applications that can help out their farming operation. And so, every time I'm doing a site visit, I'm getting introduced to new widgets and things that are helping them. And so you certainly are seeing that. I think the ag tech more generally, it can be tough to scale just because every farm business is so different in terms of what their priorities are and what they're specifically looking for. But you're certainly seeing the adoption. And to the extent we have any feedback or specific items that we think might make sense, we're happy to make those introductions. But like I said, the farm community is adopting quite quickly.
Yeah, for sure. And I think it's probably fair to say that really the highest margin production systems are probably where you see those innovations really take hold first. It just makes more sense, right? The dollar per dollar payback is more significant in the really high margin sectors of where we invest. And as Jeff said, there's no question that farmers are looking, they're business people, they're looking to improve their bottom line. And if there are protocols that can help them do that, they know about them and they're adopting them for sure. And we've seen that coast to coast. And I think if there's any trend, I could say it's clearly the higher margin production systems where there's more value at risk. They tend to be adopting those measures at a much more rapid rate. and which makes perfect sense. It's exactly what you'd expect with an adoption and innovation cycle of really any industry. Really, it makes perfect sense.
Great. We've blown through our hour, which is amazing, but maybe we'll just do one more to sort of wrap up and maybe have a positive outlook as we all go back to our day. But one question that came through, which I thought was interesting, is what has been the most positive effect of COVID-19 on Canadian agriculture, if there has been one?
Yeah, no, I think yeah. So looking through all this, I think really looking at how good a group of folks that we work with, how amazing the farmers that we work with really are. That's really shining through. I mean, how well they run their businesses, how well they manage the crops, how much they care about what it is they are doing. That's been coming through in spades. And I know, Jeff, you've been talking to a lot of the folks that we work with, and it's clear to me from those conversations that, if nothing else, I think the future looks really bright when we can look past probably some of the initial dark clouds that are in an immediate line of view. When we look past that, I think, clearly the trends are still in place. And Jeff, I don't know if you have anything to add to that, but it's been a very interesting experience to connect more closely over Zoom or telephone with a lot of the farmers that we work with.
Yeah, I'd say to wrap it up, and like I said, we've as we've been kind of providing regular updates, the themes don't change a ton. I mean, I think the general consensus from the farm community, relative to other industries, we're doing pretty well. Obviously we wish we weren't in a COVID environment, but in terms of an industry that's probably better suited for, social distancing, in terms of macro trends of people still needing to eat, these are all things that have continued to play out. And I think farmers are really optimistic. We haven't seen a mass flooding of land onto the market. People are going about their business. And I think they're more hopeful that the weather cooperates this year than any COVID-specific activities. So once again, it's probably easy to get pessimistic about it. But like I said, I think the folks we work with are pretty optimistic. So hopefully it's a good growing season for them.
I love that. That's a perfect spot to stop. Thank you both so much. This has been tremendously helpful. And I think there was an incredible amount of information shared here today, and we will make the video available on our website at globalaginvesting.com. But in the meantime, I encourage you all to head over to bonnefield.com and learn more about what these guys are doing. Thank you both again. This has been great.
Thanks, Kate. Really appreciate it.
Thanks a lot for having us.
Stay safe, everyone. All right. Bye-bye.